Intel is down today around about 8% to $40.41 a share. This is due to the company revealing its $7 billion operating loss in the foundry business. What we're going to be doing today is looking at the news, see how it's affecting the stock price, then go to my automated stock valuation spreadsheet to see if Intel is a buy or a sell using the discounted free cash flow model, the comparable company model, and finally the Ben Graham formula for intrinsic value. So let's just get quickly into the news here. As you can see, the stock is down and Intel shares fell more than 4%. That's 8% currently in extended trading after the company revealed long-awaited financials for the semiconductor manufacturing business. This is the first time Intel has disclosed how much the foundry business makes in sales. And as we can see here, the foundry business recorded an operating loss of $7 billion in 2023 on its sales of $18.9 billion. That's a wider loss than the $5.2 billion that Intel reported in its foundry business on 2022 for the $25.7 billion in sales. So let's just quickly look at the share price. What we have been seeing from Intel is this did have a recent boost, up almost 22% on the year. If we compare that to the S&P 500 in the similar time, was beating the S&P 22 versus 26%, but obviously today has brought them down. But if we look at the 5-year chart of Intel, a very different story, down 27%. So let's have a look at the company financials. So if I go to my automated stock sheet here and just type in the ticker, it will bring back all of the company's financial data. $40 a share, down 8% on the day, market cap of $170 billion, PE ratio of 100. Now if we compare that to the average of the market, which is around about 28, that is a little bit on the high side. Earnings per share of 40 cents a share and a beta of 1, which means it is not very volatile despite the 8% drop today. Target price of $45 a share. So in terms of dividend yield, 1.12%, which is about 45 cents a share. They currently are paying out $2 billion dividend, and if we look at the payout ratio here, this is not looking good. Obviously, they have a net income of $1.7 billion, so they're paying more than their current net income. And in terms of free cash flow payout ratio, it's a negative number here. That is because they have negative free cash flow. So currently not a very safe dividend, but if we search for Intel in here, you can see historically that it has been a safe dividend. The ex-dividend date is expected to be around about on the 6th of May, and you can see they have consistently paid out a dividend for the last few years, but currently this is not a very good sign. Let's have a look at the revenue here. This is the revenue going back from 2009. Over the last 5 years, minus 5%. They had highs in 2021, and it has dropped down quite a bit. Trailing 12 months up a little bit, but as you can see, it was trending up and dropping off basically since 2020. Net income, similar story once again, 1.69 billion. They did have around about 20 billion pretty consistently, dropped off massively in 2022 and down again. So this is not looking good. Shares outstanding, what are they doing with their shares? Well, they are buying them back. Why is this good? Because they are rewarding shareholders. But once again, if you go back to the 5-year chart, they're buying back shares at $40 and $60 a share, and then it drops down to 25. Probably wasn't the best idea then. They could have been using that capital elsewhere. Assets versus liabilities. You can see here that the liabilities has consistently increased, which once again is not what we like to see here. And finally, free cash flow. Minus 200%. Obviously, these numbers aren't going to work too well because they were positive free cash flow up until 2022, where it's been negative 2 years, minus 9.4 and minus 14 billion. So let's get on to my discounted free cash flow model. This is a way of valuing stocks based on their projected future free cash flows. And let's see what it gives us a number here, $11 a share. Now, the reason for this is the big hit they took in the trailing 12 months of the 14 billion. So you can see here, this is the reason for that. Now, if we go to the sheet here and let's have a look at the prior numbers, see what we can see. Now, revenue growth, if we were to compare what analysts are expecting in terms of growth over the next few years, analysts are expecting 43% growth. That is very, very bullish. Obviously, they're expecting good things from the semiconductor side. Let's even go with 43 just to see here. Still a $34 stock, and I don't think that is, sorry, that's net income margins. If we go to here and change this to 43% growth, obviously that would be an NVIDIA level growth. Let's go a little bit more bearish on that one. Net income margins have been pretty consistently, so I think that's a fair number, and the free cash flow number has been all over the place. So I think discounted free cash flow is very hard to measure on the stock, especially on the more recent things, but overall it is saying it's not a buy. Now if we go to the numbers of 85% on the free cash flow to net income, and then we expect revenue growth of about 5% a year, that would put it at about a $38 stock. Next, we're going to have a look at the comparable company model. This is a way of valuing companies comparing versus their competitors using certain metrics. What we're looking at here is EV to revenue, EV to EBITDA, which is earnings before interest, taxes, depreciation, amortization, and PE ratio. So let's just put in some of the big hitters at the minute. Obviously, NVIDIA, which I believe is the third largest market cap company in the US, AMD, and we'll go with someone a bit different there, IBM. Now, if we look at the market cap of NVIDIA, $2.2 billion, blowing out all these out of the water. Things that I'm looking at here is, in terms of revenue, yes, very similar. They've got pretty consistent revenue apart from AMD. Revenue growth rate, that is a big difference here. NVIDIA and AMD are growing. Intel and IBM are not. EBITDA, we'll talk about those. Net income margins, profit margins, 50%. For NVIDIA, they can basically charge what they want at the minute. Profit margins of AMD and Intel are quite similar. They're on about 3 to 4%, and IBM is 12. This is the PEG ratio, which was price to earnings growth ratio, popularized by Peter Lynch. 1 fairly valued, higher than 1, overvalued, under than 1, undervalued. So as per PEG, it is undervalued. The only stock here that isn't is IBM, even NVIDIA. You can see here that obviously a lot of things don't value NVIDIA quite well, but according to this, it's only slightly overvalued, and it's the third largest company in the US. Now we're looking at the metrics here, and you can see basically it says it's a buy, but I think this is because of the higher EV to EBITDAs and EV to revenue numbers of NVIDIA and AMD. Now, in terms of PE ratio, that is the closest with $55 a share. This is because of AMD. So what I will do is I will just compare it directly to IBM, which I think is a bit more of a closer valuation. And you can see the stock is probably slightly overvalued if we're comparing to IBM. EV to revenue, EV to EBITDA, and PE are similar. Well, not PE, that's 109 to 23. And finally, we're going to have a look at the Ben Graham formula for intrinsic value. This is a way of valuing stock, which was devised by Ben Graham. This is looking at earnings per share, the growth of a PE of a non-growth company, AAA bond yield, and the corporate AAA bonds. So as we saw, actually, analysts are expecting, I believe it was a 43% growth despite the negative 30 over the last 5 years. So let's put in 43. I have a sneaking suspicion I'll actually like the stock. No, still doesn't. This is because of its very low earnings per share. So even with the growth, Ben Graham says it is not a buy, valuing it around about $17 a share. So Ben Graham model is not saying it's a buy. Comparable company model comparing to IBM says it's probably slightly overvalued. If we bring AMD and NVIDIA in the mix, it is actually a buy based on their EV to revenue, EV to EBITDA, and even PE ratio as well. Actually, let's compare it specifically versus NVIDIA and AMD. Let's get IBM out of the way and see if it is a buy. Yes, this is because of its low EV to revenue numbers and EV to EBITDA numbers, but PE ratio, it's higher PE than NVIDIA, which I would have been quite surprised at, but obviously this is because of those low net income valuations at the minute. Yeah, so overall, the sheets are saying it is not a buy, but if you want to check out my automated stock valuation spreadsheet, please check out my Patreon. Links are in the description and down below. And give a comment on any other videos you want me to release. I'm probably going to release this one as I'm recording it today, and then maybe put another one on. So please give some comments down below if you want to see any videos. Right, guys, thanks for watching, and speak to you next time.